Welcome back, traders. Okay, so now we've looked at quite a few different ways to enter the market, and specifically where to enter the market. But now we need to figure out, where do we get out of the market? We have two things that we need to keep in mind with every single trade. The first and most important is your stop loss. And stop loss is exactly what it sounds like. It's the point at which you stop your loss. Now, whenever deciding where to put your stop loss, I know a lot of other companies and groups out there and people you come across on forums will say just put a 20 pip stop loss, or just put a 50 pip or 100 pip, or they have sort of a random number that they just kind of assign as a stop loss. We prefer to think things through. Now, when you're entering a trade, you're basing that on a particular set of rules depending on what system you're trading. That should tell you where your stop loss should be as well. For example, the system that we've been looking at here, we have a couple different triggers. We have a crossover trigger, we have the MACD where it's leaving, and we could even start using the stochastics as a potential entry point. But in all of these cases, we are following the general idea that the market does not move in a direct line, but rather it could go up a bit and then come down, and then larger ups and a small down and a larger up, and so on and so forth. So every single entry opportunity we have, especially on the 5 and 10 crossover, we would have a recent hump. For example, right now, we're looking at this trade here at the top right. Now, if this goes ahead and it crosses the 10, and we get a confirmed crossover, and we're happy with everything down here, we would go ahead and enter a trade. I'm going to zoom in so we can see it a bit better. So this could be a possible entry point. Now, because we are buying, we want to look for the most recent low, and that's quite clear, it's over here. We always have a kind of movement like this before a buy. And the same applies for a sell. If we look at potential sell positions, like over here we had the 5 come and cross below the blue, we would have had a recent high, and so our stop loss could be just above this point. So now that we know where our stop loss would be, we would set it about here. So I'm going to go ahead and I'm going to put in a price label just so we can mark off and see where the stop loss would be. And now, in order to limit the amount of money that you could lose, what you do is you measure between your entry price, and while we don't have one yet, we can use this as an example. Let's say we're entering a current price. So we measure from there down to where our stop loss would be, and we can see there that it would be 379 points, or we could call that 38 pips, and just to make life easier, we'll round it up to 40. You can bring out your calculator and you decide how much money are you willing to risk on this trade. So just to keep maths easy, let's say you're willing to risk $100. So you can go to 100 and then you divide it by however many pips it is to lose. And now we can see that you would be trading at $2.50 per pip. Now, how this helps us is it lets us determine what volume we're going to set when we enter the trade. For every one full lot on a currency where you have the US dollar on the right hand side, you would be making or losing $10 per pip. So if one lot is $10, 0.1 lot would be $1. So this means our volume would have to be 0.25. So I'm going to go ahead and place a trade here. We click on new order, make sure that we're on euro dollar, and we've set the volume to 0.25. That's a quarter of a lot, so we should be trading at $2.50 per pip, and I can select buy by market. I could enter the stop loss immediately because we have the price label here. It would be easy enough to read it off and type it in, but there's another fun way to do it. So let me first click buy. Now we get our order information here. I'm going to select OK. Now you'll see on the euro dollar charts, if you place the order, you will have this green line here. This is the price at which we entered. It will be slightly off the current price. This is because it's including half of the spread up front. So we go ahead and we click on this green line and we drag it to where we are going to have our stop loss, which is just below here. The first time you do this, you will have to agree to the terms and conditions, and then we can do it again. Now when I let go, it's automatically put in the stop loss. So now if this trade does reverse and turn down and it hits this number here, then it'll automatically kick us out. What's very nice about a stop loss is that this order actually sits with your broker. So if you lose internet for whatever reason, if you're having power cuts in your area or anything like that, for whatever reason, if your computer goes down, if you're not at it, your stop loss is recorded at your broker. So if the markets cross that level, it'll automatically trigger, and then you stopping your losses, you're cutting it short. Now when we look at our stop loss to take profit, we've made a decision. We've said that between here and there, we are willing to risk $50. Now, ideally, you would want to make at least $50 profit, because you don't really want to be targeting tiny amounts. You don't want to make $10, $10, and then lose 50, because you would have to have a monstrously high success rate just to break even. So if you don't feel like you could actually get your full profit, if you don't feel like you could get $50 or at least as much as what you're risking, then it's not worth trading. If you needed to get up and leave, perhaps you have work to do, you want to go somewhere, or maybe it's late at night and you just need a bit of sleep, you can go ahead and set a take profit. And the easiest way is to click and drag and now move it up. And we're going to set it at about the same distance as we were to our stop loss. So now if the market heads on up, the take profit also sits with our broker. It will trigger and we'll take our money. The same idea applies for everything. This is on the 1 hourly chart. I'm going to load up another pair. We're going to add Market Watch, and we're going to right click on symbols and load up all the symbols. And now I'm going to look for some other fun ones to try out. Dollar Canadian is often fun. The dollar Swissy is cool. Dollar yen. And then the classic pound dollar. Now you'll see when we get to create a new chart, under here we have a few more. Remember, each broker will have this section a little bit different. So yours might be different to mine, but you can find things in very much the same way. By loading up the Market Watch, a right click, select symbols and find what's there. We're done with Market Watch, so I'll get rid of that. Let's go ahead and open up the pound dollar and apply our templates. Now we can see on the 1 hour, we're in a buy position, but from all the way back here. So clearly this is far too late for us to be entering a trade. If we drop down to the 30-minute chart, we might have some more success. Yeah, also the trade started off earlier today. And on the 15 minutes, we had the same thing at a very similar time. So it looks like for now the pound dollar is not going to give us a trade. Now when you come across this sort of thing and you see that yes, the pound dollar is bullish, we have a look at the 1 hour chart, we see things are trending up, and the smallest time frame we want to consider is the 15-minute. In order for us to get another buy signal, the market would have to come down for say maybe 2 or 3 candles, then it would have to turn back up. And that'll let the red line come below, it'll give us a new low, and as it turns up it'll hopefully cross and give us a new entry point. But we can see that this is not going to happen anytime soon. In order for this to become a low, we would need at least 5 candles, and at 15 minutes per candle, that's what, an hour and 15 minutes. So there is really no point in sitting and stressing about this.